Welcome to subramani.com. If you have not yet subscribed, please subscribe to the channel and click on the bell icon. Today I'm going to talk to you about valuations and the value investor. And anybody who told you that value investing is easy must be a professor who has not dealt in the share market, right? So what are the problems in being a value investor? No, I'm not going to really talk about the problems. I'm just going to talk to you about examples of in the current market and from historic numbers. So during times of highly inflated prices, like Naren says, we know what happens to the market when $14 billion is pumped into the market, and none of us know what is going to happen when $14 billion gets withdrawn. We all know that there is a COVID crisis, but none of us know when it will be over, whether a vaccine will be found, nothing. So if you are a value investor, is this the time to be buying in Indian markets? Is it a time to be selling in Indian markets? Is it a time to be selling in the US markets? Because currently I know almost all IFAs are hell-bent on telling people, Array, you must invest in US markets. Please understand, the US market has had an 8-year bull run. And Biden can come and screw the market, or it will be Trump's turn. We have no clue who is going to do what, but you need to be beware, and you need to understand that some of us who have entered 4-5 years ago should be happy to take profits, at least some of the profits off the table. You don't know what's going to happen, but they are taking some profits off the table. Makes you a smarter value investor than saying, no, America can't go down, you can't live without Facebook, you can't live without Google. Maybe true, but everything good quality at a particular price, right? So the price is what should make you a value investor. So it needs a lot of patience to sit tight doing nothing, having money in the current account or savings bank account, and your broker saying abhi nahi, abhi mat kharido, right? So every share looks attractive because it's all fallen from the top, and therefore it is attractive. You look at a share and say it can't go below this, but it can't go below this is not a reason to buy. The reason to buy is it will go up from here, right? So maybe there is a share which is at 9 rupees today, and you say it can't go below this. That's fine, but is there any reason why it should go from 9 to 10 or 9 to 20 or 9 to 900, depending on how deep value you see in that, right? If you don't know that, then don't buy. You don't be in a hurry to deploy your money. That is the easiest. Deploying your brain is difficult. Deploying your money is not so difficult. Any fool can write a check, right? So when you sit on cash, you also need the guts to act decisively when an opportunity presents itself, right? So whether it was in the month of March when there was an opportunity, or now when in some companies maybe there is an opportunity, in some funds maybe there is an opportunity, you have to act decisively and say, okay, here I am taking a 5-year view. So if I bought Tata Power at 30 rupees with a 5-year view saying I expect to sell it at 100 at least, at 50, what do I do? Either I sell partially and book some profits and say, look, 53, 55 is not bad. You just bought it 3 weeks ago, 4 weeks ago. So it's not a bad thing to double your money in 4 weeks, right? Or you say, no, let me ride it longer, right? So one of the two, whatever, but you need to act on that, and you have to sit tight sometimes saying, I'll do nothing. Maybe you bought Vodafone Idea at 8 rupees, and you're saying, okay, if they repay the loans, it means they will do something, they will come out of it, their phones are not doing too badly, so maybe the ARPU will increase, and maybe I'll get a chance to exit at 20, right? Perfectly possible. Again, are you a value investor by buying some of these at a discount? I really don't know whether you're a value investor or are you seeing value coming in form of growth. It is not easy. Patience may also be required. First of all, patience is required in all kinds of market, in up market and a down market. And believe me, you require it dramatically in a rising market so that you don't sell. So when a person entered the index entered the market when the index was 3,000, would have been hugely tempted to sell at 6,000, 9,000, 10,000, 12,000, but the market went to 21,000. Would you have had the patience to stay in the market from 3,000 to 21,000? That is the question. And nothing wrong if your 3,000 becomes 6,000, you sold off. That's not a bad deal at all. But subsequent activities and market reactions make that deal look very bad, because it look like a बहुत जल्दी profit book कर लिया. That's another pressure for the value investor. How long should he wait? I believe if you bought a share which you're expecting it to double in the next say 3 years, and that's how you look for that is how you look for return, then that's fine. But if it doubles in 4 years instead of 3 years, that's also fine. But if it doesn't double, or if it is not moving after 2 years, it's time you got out and didn't pretend that abhi kuch hoga, that kind of a thing, waiting that no, I'm not going to sell till it reaches my target price. That doesn't make sense. So be careful. You might get opportunities in stressed assets, right? Bankers sitting with assets which are just not moving, the promoter is doing nothing. You might get good valuation somewhere there. Somebody might launch a stressed assets fund. That is so it's a good time to be looking for opportunities. And please understand, even the 2003 to 2007 was an infrastructure boom, banking boom, an IT boom, but it was not really a boom for everything else, right? So maybe it was not so much of an IT boom, because IT boom was prior to that. In September in 2000, IT really boomed. But your pharma and your FMCG never moved. So in 2007, if you sold off some pharma, etc., it was bad. It was a bad decision, because those had not moved. So as a value investor, even moving between industries is a good thing to do. And you can look at doing something like this even now. Some industries may not have done well, some may have done well, some may be over discounted, but some may be overpriced, right? Be ready for all that. I remember in 2017, Gillette looked very expensive at a high PE at a price of 4,000 rupees. But believe me, 6 months later, the price was 5,000. It then again went up. It went up to 8,000-9,000, and now it is back to 5,000 or 5,500. So these kind of things will happen. Some overinflated assets can keep going up and then come down. So you have to decide at what stage you want to get off the bandwagon. You bought it at 70 rupees or 100 rupees or whatever. You watched it go to 5,000. You are very happy. Then you watched it go to 9,000. You didn't sell, and now it is back to 5,000 or 6,000, whatever. I'm not saying it's a good buy or a bad buy, but be reactive to price. You say, okay, I don't think this price is justified. You get rid of it. Yes, there could be regret if it goes up again. Now, other problem which people don't realize is the reliance of 2017 was very different from the reliance of 2020. It has got a platform. People have recognized the platform. People are willing to invest. International marquee investors have put in their money. So all of us will have to wake up and say, what does a Facebook want out of this, right? So obviously they're not looking for 3% return or 2% return which they can get in a savings bank account, right? They expect to rock it. There could be a business decision apart from the return on investments, but then those are the opportunities which you have to be alert to. Gillette gave us a great buying opportunity at a high premium at 4,000 rupees and an exit at 9,000 rupees, but it was not driven so much by PE as by sentiment saying, I have made a lot of money and let me get out. So that is not to do with PE, but yes, sometimes you take emotional decisions and you're right? I remember buying a share called Rane Madras. I remember buying a share called Apollo Hospital. All these shares I bought just for dividend yield, and there used to be pathetic return in terms of appreciation. There was no appreciation in Apollo Hospital for a long time. There was no appreciation in Rane Madras for a long time. But after that, both shares galloped. If you look up the price of Rane Madras, that also galloped, right? So it's important to know why you are buying, what is the story, is it a dividend yield story? And you can sell off a dividend yield story and look very sad, because after that the market could keep going up. For example, I bought Apollo Hospital at 9 rupees 75 paise to get a dividend yield. I got the dividend for a long time. Then at 135 rupees, the story had gone. There was no dividend story anymore. So I sold, and after that I had the mortification of seeing it go up to 700. So I bought again at 700, sold at 800. And then I watched it go past 1800, right? So these things will happen. You have to look for opportunities. There is no harm in booking profits, but when you book profits also, remember that you can go back to the same share and buy it again. I sold Apollo at 135, I bought it again at 630 or 640 and again sold it of 800 and odd, right? So you can do these kind of things, saying, okay, in a worst case scenario, if I'm stuck with this company, it's not so bad, right? So those are the things that you look for. Then you look for certain names and say these names don't fall, but don't be so sure, because today somebody can create a fund which invests in all the parent companies of the Indian companies. For example, an ESAB, or Colgate, any of these, they can, if I create a fund which will invest only in those companies, right, so I could go and invest in a mutual fund, they go and buy Unilever, so I sell off Hindustan Lever simply because, as a comparison to Unilever, I think Hindustan Lever is overpriced. So what am I doing? I'm doing an arbitrage. If tens of thousands of people start doing an arbitrage, what happens? Right, you know what happens, right? So you have to be alert to all these things which can happen. The other problem for the value investor is he might sell off too soon. So you bought a share at 10 rupees, you think it will go to 200, fantastic, but at 50 you panic and you say, okay, let me take the profit, no harm in taking the profit, so you sell off, and then you have the mortification of seeing it go from strength to strength. So these things will happen, be ready for that also. As a value investor, people will laugh at you. There are times when you have to look sad, bad, ugly. You could be riding something a little too long.